Cosmos presents Certified Financial Guardian, a seal of ethical selling. We are privileged to bring to you Mr. Arvind Chari. Arvind has 14 years of experience in the Indian fixed income market as a dealer, analyst and a portfolio manager. He joined Quantum as a research analyst to build the fixed income and macroeconomic research function and to help develop fixed income products of Quantum Mutual Fund. Currently, Arvind is the head of fixed income and alternatives at Quantum Advisors Pvt Limited. He has to his credit a master's degree in commerce and MMS from Mumbai University. Arvind, thanks for joining.
Thanks for having me.
We'll discuss is too big to fail story risking investors' money in the Indian debt markets. The Indian corporate bond market is in a bad state. The credit rating downgrades and defaults seem to have become a regular affair. Even too big to fail names like LIC-backed ILNFS, some big NBFCs like DHFL, and now Z-backed SL Group have been exposed. So, do you think Indian bond market is heading towards its one of the worst crises ever? How would you, as a fund manager, tackle this situation?
Okay, it's a great question given the current context. You have to see the current environment where what has happened in the last, I think about 5-7 years. We've seen corporate India not in the best of strength, and that has been manifested initially in the bank NPS. So the banking sector took the first brunt of a lot of rising NPS, right from 2012, from the infrastructure sector, 2012, 13, 14, and then as the commodity cycle went down, oil prices fell and metal prices fell. You also saw metals and those companies getting impacted. Initially, given that larger exposure to what we call credit, corporate credit, was in the banks and in the banking space, you've seen that, and eventually we have seen bits and pieces examples in like 2014 in mutual fund with Amtech Auto and Deccan Chronicle and then Jindal Steel, and we've seen more instances as you've pointed out. So that's the background. So the corporate sector itself has been over leveraged. In the infrastructure space, there's been policy uncertainties, policy irregularities, which has also impacted cash flows and profitability of infrastructure companies. And metals, because of just the pure commodity cycle, has got impacted. So that's the background that we're seeing. I don't see it is a thing to worry about, but in a development of any market, in this case the corporate bond market, you're bound to have fits and starts like this. The reason it is so much more in media today than maybe in 2008 or 2013 is that the exposure of mutual funds into what we call credit risk, either credit risk funds or through exposure to lower credit rated corporates like or small corporates through liquid funds or short term bond funds has increased, especially in the last 3-4 years. We've seen a very high allocation towards lower rated commercial paper or lower rated corporates, and that's why you're seeing so much media hype, and that there's articles in media about highlighting this issue, rightly so. So that's why you're essentially seeing that is it a crisis? As a fund manager, the thing to look at in corporate segment, especially when you're buying AA minus or below, is that the secondary market liquidity for those assets is very, very low, and sometimes it is practically non-existent, especially when there's a crisis. So if there is a crisis, there is actually no buyer. So even as a fund manager, you believe that, say for example, ILFS or SL Infra had an issue, it is very difficult for you to exit that paper, sell that paper. Whereas in a government bond, when if you expect you're basically holding long-term maturity government bond and you expect interest rates to go up, there is still exit. You can go and sell in the secondary market. Because the secondary market is so illiquid in India, essentially all these investments are like hold to maturity investments. So it remains in the portfolio and you are not able to exit it. And then either you have a write down if it's a default, or in the current case where there's been extension of maturity. So
that was quite a great insight. Okay, the credit rating agencies have somehow failed in the evaluation process. They take the example like they initially assign the higher rating to cash flow deficient ILNFS entities, group entities basically, and then suddenly downgraded them. So should fund managers still rely on the ratings assigned by the rating agencies?
Okay, this is a question that will keep getting asked. Not only in India, it's been a global debate on credit rating agencies and their practices in there and whether it should be tracked or not. Specifically on the ILFS issue, I think, as per my memory, it's the only AAA rated entity which has gone directly from AAA to D, like a default. We haven't had any other instance like that. Purely from a investment perspective, and you asked me what fund managers should do, I think credit ratings or credit rating agencies should only act as a supplemental information to your investment making process. You cannot completely rely on a credit rating agency to make all your investment decisions, and I don't think fund houses do that. I'm assuming there is enough in-depth research, proprietary research, and you use, just as maybe equity fund managers use broking companies and broking reports as a supplemental information, you use credit rating agency as a filter and as a information. And interactions with credit rating agencies, at least we found out, is helpful, because when you discuss with them a corporate on what their rationale is, you tend to understand where they are coming from, and if you don't believe entirely in what they're saying, then you can make your own assessment and invest. Credit rating agencies, not depending on them also is, back to my earlier answer, is if you are doing a investment in a lower rated credit, in your mind you have to be prepared that, say it's a 2-year bond, you're buying a 2-year bond of a single A rated paper, corporate. For the next 2 years, you have to be prepared that you will have to hold this asset for 2 years, because as I said, secondary market liquidity is poor, and especially so when you need it. So when you're doing the assessment over the next 2 years, you should be comfortable remaining invested in that corporate, in that business, and in that management, all these three things. Whereas a credit rating agency can give a rating today of, say, a AAA, but if something deteriorates, either the management has an issue, or debt levels go up, or the business suffers in some other manner, they can actually downgrade. And if and they downgrade, but you cannot sell, so you have to be prepared. So rating agencies anyway in that scenario cannot be the only be all and end all of your investment decision making. From their side, I would still think credit rating agencies have to be a lot more transparent and disclose a lot more information on what goes into why they have assigned that rating. They do come out with a press release, they do come out with a rationale, but I think much more publicly available data on what are the factors, why did they give, and remove financials and management separate and discuss them slightly in more detail. I think that will help, and that will also help increase confidence of investors in credit rating agencies themselves. And when I'm saying investors, mutual fund investors and the investors who are investing in mutual funds, because they're also looking at credit rating of portfolios. So I think it will go in a long manner. Although SEBI has made a lot of efforts in tightening regulations and making them more transparent, I think more analytical data on what are they looking from the industry, from the company, from the management, how are they grading them, will help.
Sure. It has been a nightmare for liquid fund investors who park their safe money in funds that saw quick erosion in value basically when the ratings downgrade happen. So where, according to you, did the fund managers go wrong, and do you think they will learn from their mistakes, or would they still continue to chase higher yields by taking higher credit risk?
It's a good question. I mean, what I believe is that each product has a particular investment objective that it fulfills.
Right.
A liquid fund is essentially an alternative to bank savings account. So, so the common pitch or the profile of the fund is that instead of keeping your money in savings account, or short-term fixed deposits. Invest in a liquid fund. It takes very low market risk and it gives you money whenever you want. T+1 liquidity, and today you have insta redemptions where up to 50,000 rupees you can get in immediately at a click of your button. So that's the objective of the fund, that we'll keep your money with low risk and we'll keep your money as liquid. So safety of capital and liquidity of capital has to be the most important objective of a liquid fund, and then comes returns. That's how it's always been. But in the last 3-4 years, seen especially in portfolios, and I think PersonalFN did a note on credit exposures of liquid fund. I think you came out with data with that 65-70% of a liquid fund portfolio is now invested in below AAA or private entities. That's a matter of design, because what also has happened is that bank CDs, certificate, which used to be the bigger investment exposure, outstanding has gone up and commercial paper outstanding has increased. Right. But I would also believe that there has been a tendency to sort of chase yields and give slightly higher returns in a product where that was not the initial objective of that product, and that's why you see in almost all cases of defaults that have happened since 2013-14, there has been a liquid fund also involved, and that's the dichotomy in my sense, that I don't think the investor, whether it is an institutional investor or a retail investor, although all investors want the best returns and the lowest risk, which always doesn't happen, but in liquid fund at least I don't think investors are ready or capable to take or understand that there can be credit risk. And that's why when you ask me that question, that people have been shocked, and that's where the shock element comes in. In a liquid fund which is positioned as an alternative to a bank savings account, why do we have to have market risk? So I think I think the industry is already because there has been so much media exposure towards that aspect, that should liquid funds be taking as much amount of credit risks as they are taking, and if they are taking, are they communicating to investors that they will be taking credit risk? Once you communicate that I'll be taking a lot of credit risk in my liquid fund also, then that's fine. I mean, then the investor knows that the fund is taking. Otherwise, especially from a liquid fund perspective, because just see the amount of retail investors that are investing today in equities, right? You've seen a significant increase. And a liquid fund essentially is a very, very, very good entry product for any investor. So if you look at it got a mutual fund also, there has been a significant amount of investors who park their lump sum money in liquid, and then they use the liquid to do what we call systematic transfer plan or switch into the equity fund whenever as per their liking, or if the equity market corrects substantially over a period of time, then they do switch transactions. Now that investor is not prepared to take any credit risk or default risk in his liquid fund exposure. Right. He would have rather kept it in his bank savings account and done the same in SIP or investment, but he's choosing to do it through a liquid fund, and this should be happening in other funds also, and it's only going to increase. Liquid funds are the first entry point, should become the first entry point for any investor. It also over a period of time tends to give you slightly higher returns than bank savings account. I won't say bank FDs, but over and above the bank savings account. And with insta redemption, these facilities are increasing. Today you have apps where you can invest purely on liquid fund. Given that is where the positioning is, the industry has to think that is credit risk or higher credit risk a better option for liquid fund, and if so, then are you communicating that? And is the investor aware that he may lose a year's return in a liquid fund if there's a default?
So now that we are talking about a safety element involved with liquid fund, so what is your take on the relatively new category in the mind of investor, that's the overnight funds? Yeah. They are evolving as a close substitute for liquid funds in terms of safety, of course. Yeah. So does it make sense to invest in overnight funds?
So an overnight fund, just to explain, invests only in what we call overnight assets. So if you look at the bond market, there used to be a product called CBLO, which is now called TREPS, TREPS, tri-party repo. So a substantial amount of the corpus of an overnight fund is invested in in that TREPS instrument. So mutual fund investors have no access to that institutional daily market, which is the repo market or the TREPS market, and the overnight fund basically gives them exposure to that, as against a liquid fund which takes slightly higher market risks. So a liquid fund can invest up to 91-day instrument. So in bond markets, as many of investors will know, but it is always good to reiterate, longer the maturity, higher is the market risk. So in a liquid fund, if you go back, liquid fund 10 years back, liquid funds could buy 1 year paper or sometimes even longer. And SEBI in its own prudent manner has ensured that the risks in a market risks in a liquid funds have come down and now they're locked in it. So I think it depends on what investor wants, whether they can want a overnight fund, which I still see a largely institutional product where companies who do not have access to the repo market can access the repo market through an overnight fund. A retail investor who is moving from a bank savings account, or instead of keeping all his money in a bank savings account, is putting money, can choose a liquid fund. The key here to know is if you're choosing a liquid fund, are you okay with choosing a liquid fund which takes higher credit risk or not? That's the trade-off that investor has to see.
Great. So that was I think a valid answer from your side. And now coming to a safety aspect, like what differentiates debt fund management at Quantum vis-a-vis the other debt fund managers out there? So if you can just throw some light on this risk management practices you follow at Quantum.
It has evolved. I used to be part of the Quantum Mutual Fund, and our investment strategy has evolved. Basically, we follow what we call the SLR principle, which is safety, liquidity and returns. And on top of that sits the compliance aspect. So legality and compliance to every rule that is there, or maybe even higher. Like in Quantum's case, we are the only fund which does full mark to market. Although the SEBI rule allows us to do amortization, you should for 60 days and now 30 days, we are the only fund which does full mark to market. So legality and compliance is the main, and then the aspect of preservation of capital, which is safety, then keeping it liquid as possible, and return. Of course, it's objective, but that's the third objective in some sense. And this has evolved. It's not. It was not that we were not taking credit risk before, but as we saw crisis in the industry, I mean, one was clearly 2008. Where you could see that even if you had a State Bank of India CD, you could not sell in the market that much for at least for the 10-15 days. It was so tight after Lehman crisis. 2011 was a mini crisis after the US credit downgrade, where you saw that in the bond market also. 2013 was a very large crisis. That was the first time when you actually saw all liquid funds or most liquid funds having negative returns on one particular day. Because that's a shock, 200-300 basis points of rate hikes. And when you have events like that, you also see the true liquidity available in the markets. So whether are you able to sell your good papers, are you able to sell even treasury bills? You know, that's how you. Having seen all that, we realized and we kept on tightening our investment mandate to ensure to keep it more in sync with what is the investment objective. So as we've seen risks in the industry increase, and we've seen, as I said, I gave examples of 3 manifestation of that risk in different events. We've sort of tightened our investment mandate, saying that the liquid fund or even a bond fund, is it what kind of risks is it supposed to take, and does it continue to make sense to combine credit risk and market risk in one product, or are those two different? You know, those kind of judgments and calls that we've taken has ensured now across all our products we've focused that we will only do liquid instruments, which is essentially, if you see, it's government bonds, treasury bills, in some cases state government bonds, and AAA, what we call PSUs, quasi-sovereigns as we call it internationally, or public sector undertakings. So this is the risk profile that that we have taken. I'm not saying the quantum product will not take a credit risk. There is a credit risk when you're buying a AAA PSU also, but it's just that it is lower than buying a private credit, corporate credit risk, and it is a function of what we have learned. And in our belief, if we want to do credit, which is private corporate credit or low credit, it should be through a separate product where the liquidity risk, the credit risk, and the return profile is different from a product which invests only in interest rates. Like if you look at the liquid fund, it is purely a rate product. Even the dynamic bond fund will be a pure rate product. Whereas in a credit, the risk factors and the return factors are very different. The second larger point that we saw was the Indian bond market is fairly homogeneous. When I say homogeneous, is investors and investments behave in the same manner. So if there is a credit event, everybody gets risk covers, and you see that in bond spreads or not being able to sell. So, and the third point was we saw a lot more money being invested in credit assets, either through credit risk funds or through just purely in liquid funds. But as you know, the liquidity of those instruments are far lower. So the lower the credit of the paper, the lower the liquidity it is. So in a market which is homogeneous in reaction, in a credit event, it can amplify the risk, and this just gets amplified. So we've decided to just stay out of and keep a very low risk profile on our portfolios.
Great. Okay. So just coming to the regulatory part, what according to you are the steps the regulator should take to ensure the safety of investors' money in debt mutual funds?
I think you should commend SEBI that they've done a phenomenal job over the years, not only in debt but in equity, and generally in mutual fund practices, investment, as well as other aspects of mutual fund regulation. I think they've done and they have a blueprint in mind in which they are following, and sometimes different events happen and they react, but I think they've been fairly prudent in the way they've done it. One issue which I would like to point out is, if you know, today the debt funds are categorized, right? There are categories in equity funds and there are categories in debt funds. That categorization of debt fund is based on maturity. So you have a overnight fund, and you have a liquid fund, and you have money market funds, and ultra low duration, short term bond fund, and everything has a maturity band that you can, or as they call duration. Duration is a very misunderstood concept. It's not easy to understand. Maturity would have been better, but it's split like that. So investor knows that on an average, that if I invest in a long term income fund which takes longer maturity, which can invest in longer maturity, when interest rates rise, my NAV can fall. That, at least that is a good understanding that people will get, which may not have been very clear before, but now that is clear. My point is that there is no categorization in credit. So there is a credit risk fund, but what credit exposure can a liquid fund take, or what credit exposure can a short term debt fund take? That categorization is I think missing. And given whatever you asked me and whatever you've been reading in the last 3-4 years in terms of credit exposures, and more after the ILFS issue, the point is, are investors aware, or are they okay by the amount of credit risk that a fund can take? And if they want a no credit risk option, that is not available. You can have a low maturity option by choosing to be in liquid and ultra short term, but you don't have a no credit or low credit risk option. I think SEBI maybe should think that categorization should happen as per credit risk also, if not for all categories, but just take liquid, short term and income funds and have a category of zero credit risk or low credit risk, and you can define it, right? I think that is something that the regulator should look at.
They have given just two categories, like corporate bond funds, which can take up to 80%, which is mandatory to keep at least 80% AAA kind of, and the other is the credit risk fund, that is free to invest in any.
Yeah, but what about a liquid fund, which there is no directive, or forget the directive. Let the funds can do what they do, but does the investor have a choice if they want to invest in a zero credit risk liquid fund? They have overnight product, but should they have a low risk, zero credit risk liquid fund? Should they have a zero credit risk short-term bond fund? I think we should think about it. I think the regulator also should think about that aspect.
Now, this is something like related to you. Means if you had to invest your own money in debt mutual funds, so which are the categories you would opt for, like, and what would be your advice to investment advisors and investors?
I think first on the investment advice, I think we've seen a big movement towards IFAs. Like initially, it was very distribution was very wholesale centric or bank led, but today you have so many independent financial advisors, as they call IFAs, and their sole job is mutual fund advice or mutual fund distribution, which is a good thing, because then the client interest and the IFA's interest is actually aligned in some sense. Today you also have the RIA and practices like yours, like CFG, and I've seen many IFAs are interested in enrolling in getting a CFG. So that is a very healthy respect. In bond funds, I agree it gets tough. Bond funds tend to be misconstrued in terms of what they can do and what they cannot. We recently released a note which basically said 10x of debt fund investing. What should you look at before you invest in a debt fund? And I'll quickly summarize it. Is that the first point is that debt funds are not well generating. You should not aim to earn very high returns to generate or grow your wealth. That's not the objective of a debt fund. The debt funds are supposed to keep your returns stable, maybe better tax advantages than say a fixed deposit. That is the main role. If you are in your overall portfolio, it is supposed to reduce your volatility, as you call it. That's the role of debt fund. And the other important thing investors and IFAs have to always keep in mind is that debt funds are not fixed deposits. The returns are not guaranteed. They are not fixed in that sense. Debt funds can move, and some debt fund categories may need you to remain invested for longer, because a cycle is played over long, like in duration. Only in 2013 did people really realize that bond funds can also have market risk, right? Because there's so much money at that time in dynamic bond funds and income funds, and suddenly in the 2013 when the interest rates went up, that bond fund NAVs were actually negative for a fairly long period of time. So till you've had credit risk, the main concern with investors prior to that has always been income funds and duration and risk, sort of interest rate risk. So you have for a fund manager to play a cycle, or for you to have made a investment at a wrong time and to recoup your returns, you might have to stay for 2-3 years, and even taxability on a growth product kicks in after 3 years. And fourth, you have to understand that as an investor, and most retail investors or even high net worth are already exposed to significant amount of fixed income. You look at your whatever money you have in FDs, savings account, FDs, PF, PPF, EPFO, small savings, insurance endowments. I will classify all these as already fixed income. So you, as an investor or as an IFA, when you are looking at a financial planning for your client, include all these as part of fixed income, and then determine whether the client requires more fixed income, or in most cases you will find that the client requires more equities. So that's the first aspect. If they require fixed income, in that then debt funds are only an alternative to your existing fixed income investments. So depending on liquidity, lock-in, maturity, taxability, you determine whether a debt fund is better than an FD or a debt fund is better than a small savings NSC or Sukanya Samriddhi, those kind of products that you already exposed. Once you keep that in mind, this is just pure rule of thumb, but one aspect is when you see interest rates increasing, when you hear in news circles or you read about it and people are talking that RBI is going to hike interest rates are going to go up, liquidity is going to tighten, as an investor or as a FA, you are better off recommending investing in liquid funds, because as I said, liquid funds take low market risk, and the repricing as interest rates go up, liquid funds will keep repricing at a higher portfolio yield. Whereas if you're investing in a fixed deposit during that time, you will say you buy a fixed deposit at 6.5% for 1 year, and rates have moved to 7.5%. For 1 year, you will earn 6.5%, and next year you might be able to reinvest at 7.5. Whereas in a liquid fund, you will keep accruing 6.5, 6.75, 7. Some in that progression. So you're better off when interest rates are rising. You're better off in a liquid fund. Also, when interest rates are rising, as you know, longer the maturity, higher the risks, and when interest rates go up, bond prices fall. So it's better to avoid. The other rule of thumb, this might not always play out, but it has technically played out for a while, that when you see long-term interest rates say 8% or above as a rule, pure rule of thumb, and I'm saying long-term interest rates could be bond yields or it could be the bank fixed deposit. That is a time when you can actually put higher allocation to debt funds or lock in your money in fixed deposits. When I'm saying locking, do 3 year, do 5 year, because at that level, typically we've seen interest rate cycles peak out at about 9%, 9.5%. Similarly, when you go down, when you see interest rates going below 6, is the time when you shorten your maturity. So either you move out of income funds, move out of long-term FDs, and be in liquid funds. Pure rule of thumb. Don't hold me to it at all times, but this is just as a benchmark for you to think about it.
Okay, great. And the last one, what is your outlook on the Indian debt markets, and where are the interest rates headed according to you? What should be the one strategy going forward?
So, if you see today, post 2015-16, when the RBI moved into this monetary policy committee, and they now have inflation target. So CPI is targeted at 4%, and they have an implicit real rate, 1 to 1.5% real rate target, positive real rates. Based on that, what I believe is that if you see interest rates prior to that, Indian interest rates used to move, like the repo rate, used to move between 4.5% to 9.5%. And we have seen that play between 2003 to 2008, back in 2009, then again in 2013, we have seen that band play out, 4.5% to 9%, 9.5%. Because today we have this inflation target and the real rate, we believe that interest rates will be in a slightly narrow band between 6 and 8%. So repo rate will find it difficult to go below 6%. I'm not saying it won't go, but you'll find it difficult because Indian inflation, although currently averaging a lot lower, but the expectation is that the inflation in India will average between say 4.5 to 5%, and that's been the long average is between 5 and 5.5%. So 4.5 to 5.5% is a band. You add 1.5% real rate, then it becomes like 6%. Even now, if you see the 1 year forecasted inflation by the RBI themselves is averaging 3.4%. But still if you look at the voting for the rate cut, the last rate cut, from 6.25 to 6%, there were 2 who said don't cut. So even when inflation is 3.5%, way below its long-term average, there is a resistance to cut interest rates below to 6% or below. So so interest rates will be narrow, which is good for investors. The volatility should be lesser. The second good thing is the real rate. So positive real rates generally are better for long-term financial savings. So the RBI themselves is sort of assuring investors that over a cycle, your real rates, which is after inflation, will be positive. That's a very, very good development. And what that will eventually bring, and you have to test it. So it's not like you have to play it through a cycle. We have seen in this cycle that they kept real rates slightly above than what is required, and I think that they're trying to build confidence in that segment. But as investors get confident that RBI can deliver a positive real rate target over a long cycle, long-term investors, especially foreign long-term and global pensions, so foreign investors are very underinvested in the Indian bond market. Less than 5% of Indian bond market is owned by foreigners. In their portfolios, they don't even have like 0.5% allocation. Given the size of the Indian bond market, we should expect that a lot many more foreign inflows will come into the Indian bond market over the next decade. And these factors like tighter fiscal deficit or a high or a positive real rate these are all driving factors for the bond market. So and we should see that as if they be true to this factor of controlling fiscal deficit and real rates, positive real rates, we should see the the money coming in, both from domestic as well as international investors. Money may move from fixed deposit investment and small savings into bond funds. So if the industry also keeps that trust and the fiduciary responsibility that they have, you should see the bond funds should be a lot larger. The second aspect is the corporate bond market also will develop, because not all money is going to get invested in government bonds. There will be a set of investors who will say, I don't mind taking the risk of credit, I don't mind taking the risk of illiquidity, but I want the higher yield. So as the industry grows, you will also see corporate bond market develop in India, and that's good, because as it develops and it widens and there are more players and there are diverse investors, secondary market liquidity will also improve, and those are very good points of the Indian debt market, is what I say.
Arvind, many thanks for your time.
Thank you.
I am sure the IFA fraternity and our viewers will benefit from your insight.
Thank you.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.